Hello, my name is Eddie Tofpick. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here is your weekly technical analysis of Chicago wheat, Chicago corn, and Kansas City wheat. Chicago wheat. The dark blue highlighted neckline of the February to April reverse head and shoulders pattern, currently at 568, slowed down and eventually halted a decline from May, and during July and August halted a resurgence higher. Additionally, the congestion we saw previously from mid-February to late April impacted on the market's decline, and we formed a small bear channel since late June to the end of August. This bear channel is part of the V-top formed in May, in essence a V-top with an extension. The pressure in any such pattern tends to be for lower prices, but 4 weeks ago the market struck down to the important 38.2% absolute Fibonacci line at the 521, which ignited the very recent bullish incentive, enough to push up and out of the bear channel, as well as over the short medium moving average, currently at 566, the December 2020 low at 566, the dark blue neckline extension up through the previously mentioned mid-February to late April congestion, as well as the newer July to August based congestion that stretched up to the March 2021 low at 592, and late 2 weeks ago pushed prices up over the July 2021 low at 609. However, the move up was not sustained, as up there we also had the combination of flatlining gold long moving average, currently at 595, the flatlining mauve medium moving average, currently at where is that? That's at 598. These two, plus the surprising resistance of the July 2021 high at 609, which, to be honest, I previously hadn't rated very highly, have sort of capped the rise, or at least made the market think twice about the rise, and offer the ghost of a possible horn top. All this is interesting, as beyond these we have open air until the base of that old small descending triangle back in June in the 629 area, and also at the 50% Fibonacci line of the late May to late August move at 630. 3 weeks ago I had a suspicion that the move up might be a false move higher, but I did add the following, and I quote, "If it isn't great, but we'd need at least seeing consecutive closes over the 50% Fibonacci line of the May to August move at 630 to consider such a situation as a longer term possibility. All that being said, enough has happened for me to place a target X at 604 as a potential target for this move up and out of the bear channel." End of quote. These words still stood, and target X 604 was reached last week and again this week, but we have not gone any further, and I'm a little concerned now about the possibility of that previously mentioned ghost horn top. Chicago corn. From the small double top pattern in May, prices headed lower, below all the moving averages in mid-June, accelerating the fall once past the hurdle of the November 2020 high at 439. Prices finally halted in July between the November 2020 low at 403 and the October 2020 low at 387. Creating a teeny triple bottom, and recovering 7 weeks ago up to the 50% absolute Fibonacci line of 425. Now remember that level, 425, will become important in the future. Anyway, in the process of pulling back up, the market made a small July-based descending wedge pattern. Late 9 weeks ago, prices penetrated the lower trend line and exited the pattern. The market easily reached the primary target, but it took until mid-August to drop down and reach the secondary harder to reach target. 6 weeks ago I added a thought, and that was to look at the mid-June to late August action as a possible descending triangle. There were arguments against this idea, but I did find it elegant at the time. 5 weeks ago, prices exited out of the upper trend line of the descending triangle idea, but instead of heading higher, they headed lower, down towards the flat dark blue lower trend line. This looked like a false break higher, but the market also created another pattern, a late July to late August shallower and smaller descending triangle. This triangle, like the former one, had a false break lower, and it was finally 4 weeks ago that we saw its true direction, which was upwards. Prices punched through and for a while ran along the top of the purple late May to mid-September purple highlighted downtrend and its then accompanying short medium moving average, currently at 408. This break higher reached the primary target for the descending triangle and last week gapped up over the secondary harder to reach target X at 418. Let me be very clear on this. Despite setting a target higher that the market at the time, I had back then doubts about prices reaching it, and this is taking into account the weekly key reversal up we saw 4 weeks ago. My doubts at the time were very specific, not in the market's direction or whether it should go this way, but as I said 3 weeks ago, and I quote, "My concern is that this rally, despite what we have seen, may not have the legs on it." End of quote. Now, this all being said, we saw prices higher, including changeover. The move has pushed up through the February low at 409, the December 2020 low at 414, the significant, important and previously mentioned 50% absolute Fibonacci line at 425, as well as the mauve declining medium moving average, currently at 425 also. This week prices have come up against the next series of overhead resistances. The November 2020 high at 439, which supported the market back in late March and April, as well as the declining long moving average, currently at 438. It seems for now that the market is being held in between the overhead gold long moving average and the purple medium moving average below, though the medium moving average does look a bit more like a net rather than a solid barrier, prices occasionally pushing through if temporarily. However, that is not all, as we are also forming a pattern this very week which may well greatly influence future events. We are set to make this week a weekly key reversal. Thus, if we close tonight either over 420 or under 413, then we'll be on. The only caveat to this is that it is on the continuous charts, which I use. That being said, it's looking like a weekly key reversal up this week. Kansas City wheat. During February through to April, we saw the development of a rectangle pattern based on the 551 to 590 area. Now, please remember this area as it will become relevant to more recent action. Anyway, after the creation of V-top in late May, prices rapidly descended down to the extension to the dark blue lower trend line, currently at 579, of the late November 2023 to end of March 2024 descending triangle, along with the important July 2021 low at 578 and the March 2021 low at 559, back into that previously mentioned rectangle pattern area between 551 to 590. Since then, prices have moved sideways to lower, making a shallow bear channel, highlighted in bright red on my daily chart, and that's currently 521 to 571. Altogether, this pattern construction is the familiar V-top with an extension, as we have seen in other grey markets. And so I've said here for weeks now to look for the bright red bear channel to show the immediate support and resistance levels, and it did so, more or less until 3 weeks ago. I'd also said for many weeks that the pressure in any such pattern would be for lower prices, but the move lower 5 weeks ago was not sustained, and prices reverted back up, moving up from the significant support of the important 38.2% Fibonacci line, absolute Fibonacci line, at 533. The move higher went through the March 2021 low at 559, the green short medium moving average, currently at 573, and punched up and closed over the combination of the July 2021 low at 578 and the dark blue lower trend line of the descending triangle, and of course the bright red upper bear channel line. 3 weeks ago I said, and I quote, "This move higher is having trouble in sustaining the move higher, running to the highs of early and mid-April, mid-July and mid-August, as well as the top of that old rectangle congestion area between 551 to 590. Beyond these resistances, we have a fairly free area until the flatlining pair of the gold long moving average, currently at 606, and the mauve medium moving average, currently 608, and the interesting 38.2% Fibonacci line, the big old 2011 to 2018 move at 618. Beyond that, we have a small free area until the recent 50% Fibonacci line at 643 and the January 2015 high at 646. All this is leading me to think that this very recent move higher may not have the legs to get up through all these. To show you how I feel about it right now, this is despite the weekly key reversal up last week, so that is the weekly key reversal up 3 weeks ago. And even to target X at 627. This is the topside target I felt obliged in putting after the break up and out of the bear channel, even if I don't have that much confidence in it being achieved soon. End of quote. Well, the action since then, and I quote from 2 weeks ago, specifically on the bright green short medium moving average, well, it may have gathered enough ammunition to tackle those overhead resistances, basically the gold long moving average and the mauve medium moving average, and maybe just reach target X and even exceed it, because beyond target X there is only the January 2015 high at 646, which doesn't look that strong. That is only in the way to possibly reach the 50% Fibonacci line, the big 2011 to 2019 move at 691. I'm now wondering if the moving averages will cap this market or give it the final impetus to try higher. End of quote. But as you can see right now, the jury is out on these odd questions, though it does seem right now to favour the capping action of the gold long moving average and the mauve medium moving average.
Thank you for listening. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and at the back of this broadcast. Copyright is Eddie Topic and ADM Investor Service International Limited. And here comes the final important bit.